Audio review of textbook in economics for class 12. Introductory Macroeconomics. Chapter 1, Introduction.
Okay, so you know how we're always talking about budgeting and spending and stuff?
Right.
Like figuring out our own personal finances or maybe thinking about how companies decide what to charge for stuff.
Mm-hmm.
Well, that's all like microeconomics, right?
Exactly.
But today we're zooming out, like way out.
Yeah. Big picture.
Yeah, we're going macro, like the whole economy of a country.
The whole forest, not just the trees.
That's a good way to put it. So macroeconomics, it's about I guess the really big questions.
Yeah. The stuff you hear about on the news all the time.
Right, like why are things getting so expensive?
Right. Inflation, that's a classic macro topic.
Okay, and what about jobs? Is it hard to find a job right now? Is that a macro thing?
Definitely. Employment, unemployment, that's all core macro.
Okay, cool. So, a whole country's economy, that's a lot to think about.
It is. It's a huge system.
So how do economists even, wrap their heads around it? Do they, track every single thing that's bought and sold?
Well, no, not exactly. They use models, and one common one uses this idea of a representative good.
Representative good. So, is that, I don't know, a loaf of bread or something?
Not really one specific thing, but more like this stand-in.
Stand-in.
Yeah, for all the different goods and services the country produces.
Oh, okay. So it's a way to simplify things.
Exactly. And the thinking is, when overall production goes up, usually prices and jobs, they all kind of move in the same direction.
Right. Okay. So it's all connected.
Yeah. Like if businesses are producing more, they need more workers, and they can charge higher prices.
Gotcha. But I guess that's a really zoomed out view, right?
It is. It's useful for the big picture, but like you said, it's a simplification.
So it doesn't always tell the whole story.
Right. I mean, different parts of the economy, they could behave really differently.
Yeah, farming is probably super different from Silicon Valley tech stuff.
Totally. And that's why sometimes to really get it, you got to look at those specific sectors, like how families interact with businesses or what the government's doing.
Right, the government, they're a big player too. So, okay, micro is individuals and markets, macro is the whole shebang.
You got it.
So when did people really start thinking about the economy in this macro way?
Well, macroeconomics as a field, it kind of came into its own during a pretty rough time, the Great Depression.
Oh, yeah, the 1930s, right?
Yep. Before that, most economists thought economies would just kind of self-correct.
If there's a problem, it'll just work itself out.
Yeah, that was a general idea. But then the Depression hit, and it was like, whoa, this is different.
Yeah, my grandparents used to tell me stories about the Depression. It was rough.
It was a global crisis. In the U.S., unemployment went from 3% to 25%.
25%, wow.
Yeah, and total production, it fell by almost a third, all between 1929 and 33.
So it was a huge deal, really shook things up.
Absolutely. And that's where John Maynard Keynes comes in.
Keynes, wasn't he a famous economist?
Yeah, one of the most influential. He basically said, hang on, maybe economies don't always fix themselves.
They need help sometimes.
Exactly. And his work, it kind of laid the foundation for how we think about macroeconomics today.
Okay, so Keynes was all about understanding those big economic swings, the booms and busts.
Yeah, and how to manage them. Now, this deep dive, just so we're clear, we're mostly focusing on capitalist economies.
Capitalists, so the U.S.?
Yeah, where businesses are privately owned and they produce stuff to sell.
Okay, and people work for wages.
Right, that's the basic idea. But just to be clear, our sources point out this model, it doesn't fit every country perfectly.
Right, maybe in places where there's a lot of traditional farming or different economic systems.
Exactly. So within this capitalist framework, there are these four main players or sectors.
Okay.
First, you've got households. That's all of us. Consumers, savers, workers, the whole deal.
Gotcha.
Then there are firms, the businesses, producing all the goods and services.
Right, makes sense.
And then, of course, there's the government. They make laws, spend money, sometimes even produce stuff themselves.
Oh, yeah, like the post office.
Exactly. And finally, there's the external sector, all about trade with other countries.
So exports, imports, that kind of thing.
Right, and the flow of money across borders.
So we've got all these different pieces, households, firms, government, and the rest of the world.
Yeah, and the cool thing is they're all connected.
Right, what happens in one sector can affect all the others.
Totally. So here's something to think about. Imagine some amazing new technology comes along.
Okay, something that changes how businesses make things.
Right, and think about how that might ripple outwards, affecting families, the government, even global trade.
Whoa, yeah, it's all connected.
It is. And that in a nutshell, is why macroeconomics is so fascinating.
And kind of important.
Oh yeah, definitely important.
Chapter 2. National Income Accounting.
All right, so today we're going deep on national income accounting.
Oh yeah.
You know, the stuff that really gets to the heart of how an economy works?
Mhm.
Like, how do we even begin to measure a whole nation's income?
Right. It's a huge question.
Exactly.
And we've got some really cool sources here that lay out the different ways economists do it.
And how all the pieces fit together.
Yeah, like a puzzle.
Exactly.
It all comes down to this basic idea. What makes an economy tick? What creates wealth for a whole nation?
Right, like, is it just about having a lot of natural resources, or?
But the sources point out that it's not so simple.
Yeah.
It's more about how people use their skills and technology.
To actually produce things.
Exactly, to produce goods and services.
And those are the things that we're really trying to track.
That's the flow of wealth we're looking at.
And speaking of goods and services,
Yeah.
it's important to make a distinction here between final goods and intermediate goods.
Right.
So final goods are things that are, actually used by people or businesses.
Like the coffee you drink.
Exactly like my morning coffee.
Or a new machine a factory buys.
Yeah, anything that's kind of at the end of the production line.
Mm-hmm.
And then intermediate goods are the things that are used up along the way.
Like the coffee beans.
Yeah, like the coffee beans or the steel that goes into the machine.
Right.
Now it gets a little tricky with things like consumer durables.
Yeah, those are interesting.
Like your car is a final good in a sense.
For sure, people use them directly.
Right, but it also lasts for a long time.
Years and years.
So it's kind of a hybrid.
Definitely blurs the lines.
Yeah.
Now, the whole reason for making this distinction
Right.
is to avoid something called double counting.
Oh, yeah, that would mess everything up.
If we counted the value of the coffee beans and then the coffee...
We'd be counting the same thing twice.
Exactly. And our numbers would be way off.
So we only want to count the final goods and services.
The value added at each step.
Got it. And to really understand this, we need to talk about stocks and flows.
Mm-hmm. Those are key concepts.
A stock is like something that exists at a specific point in time.
Like a factory or a house.
Exactly, like a big piece of capital.
Right.
A flow is something that happens over a period of time.
Like the income you earn.
Or the amount of investment that's happening.
Yeah, so net investment, the change in the stock of capital.
Is a flow.
Mm-hmm.
I like to think of it like a bathtub.
Oh, yeah, that's a good analogy.
The water in the tub is the stock.
And the water flowing in or out is the flow.
So gross investment is like all the new water coming in.
And depreciation is like the water leaking out.
Yeah, so net investment is the difference between the two.
Mm-hmm.
Now, how does all of this connect to the circular flow of income?
Oh, that's where it all comes together.
Right. Let's imagine a very simple economy.
Just households and firms.
And the households are providing their labor and capital.
Factor services.
And the firms are paying them wages and profits.
Factor payments.
And then the households use that income to buy goods and services from the firms.
So it's a continuous cycle.
It's beautiful when you think about it.
It is. And there are three main ways to calculate national income.
And all of them are tied to this circular flow.
Exactly. Well, let's start with the product method, or the value-added method.
Right.
This one focuses on what each firm contributes to the economy.
So we look at the value of their output.
And subtract the cost of their inputs.
So you're really isolating their contribution.
Right. Their value add.
A good example is that classic farmer-baker scenario.
Oh, yeah.
The farmer grows the wheat.
And the baker turns it into bread.
And the total value added is the sum of what each of them contributed.
We don't count the wheat twice.
Exactly.
Now, the gross value added, or GVA,
Yeah.
is the value added before accounting for depreciation.
Right. That wearing out of capital.
And you also have to consider changes in inventories.
Inventories.
Yeah, like if a company produces more goods than they sell,
Oh, I see.
that counts as investment.
Got it.
And when you add up the GVA of all the firms in the economy,
You get GDP.
gross domestic product.
Okay, so that's the product method.
What about the expenditure method?
All right, so this one focuses on spending.
On final goods and services.
Right, so breaks down GDP into four main categories.
Consumption, investment, government spending, and net exports.
Consumption is all the spending by households.
Investment is the spending by firms.
Government spending is, well,
Self-explanatory.
the net exports is the difference between exports and imports.
So it's all the spending that's happening in the economy.
And that gives us another way to calculate GDP. So we have the product method, the expenditure method.
And don't forget the income method.
Oh, right, the income method.
This one looks at the income earned from production.
So wages, profits, interest rent.
all the factor payments we talked about,
And the idea is that the total value of what's produced
has to equal the total income generated.
makes sense.
So GDP can also be calculated by adding up all those different types of income.
And the amazing thing
They
is
all lead to the same number,
all three methods give you the same GDP.
which is pretty mind-blowing.
It is.
Now, there are a few different ways to report GDP.
Right.
You've got factor cost, which just includes those factor payments.
Wages, profits, and so on.
Then there's basic prices, which include some production taxes and subsidies.
And then market prices, which include all taxes and subsidies.
Those are the ones you usually see in the news.
And India has actually shifted towards reporting GVA at basic prices and GDP at market prices.
Interesting.
But we're not just talking about GDP here,
There are other important measures.
like GNP.
Gross national product.
That includes net income from abroad.
And if you subtract depreciation from GNP,
You get NNP.
net national product.
And then national income itself is NNT at factor cost.
So there's a whole family of national income aggregates.
And it's crucial to understand the difference between nominal and real GDP.
Oh yeah, that's a big one.
Nominal GDP uses current prices.
So if prices go up, GDP can increase even if production hasn't changed.
Right.
Real GDP adjusts for inflation.
So it gives you a more accurate picture of how much is actually being produced.
And the GDP deflator helps you see how prices are changing overall.
Now, even though GDP is a really useful measure,
It's not perfect.
it doesn't tell us everything about an economy.
It doesn't capture things like income distribution.
Right, like how evenly the wealth is spread.
And it mostly ignores non-monetary activities.
Like volunteer work or
Yeah.
housework,
And it doesn't fully account for externalities.
like pollution.
So GDP is a good starting point.
But it's not the whole story.
Definitely not.
So as we think about national income accounting and all these different measures, what do you think is the most important takeaway for our listeners?
I think it's important to remember that GDP is just one piece of the puzzle.
Right.
It tells us a lot about an economy's output.
But it doesn't tell us everything about well-being.
It's just one way to measure progress.
And we need to consider other factors, too.
Absolutely.
Well, I think that's a great place to wrap up our deep dive.
Yeah, we've covered a lot of ground.
We talked about the product method, the expenditure method, and the income method.
And all the different national income aggregates.
And we talked about the limitations of GDP.
So hopefully our listeners have a better understanding of how economists measure the economy.
And what those measures really mean.
Exactly.
And we'll leave you with this thought. What does true economic progress look like to you?
It's a question worth pondering.
Thanks for joining us.
See you next time.
Chapter 3. Money and Banking.
All right, so today we're going to really get into the stuff you sent about money and banking.
Oh, yeah.
It's super interesting.
Yeah, sure.
So we're calling this a deep dive, right, into money and banking, how it all works.
Sounds good.
We're going to talk about, what is money even? How does
Yeah.
it work? What's it for? How
Yeah.
much is there? Who controls it? All that kind of stuff.
All the important stuff.
And we're going to do it hopefully without, making your head spin too much, right? Keep it nice.
Straightforward.
Straightforward, exactly. Okay, so
Right.
let's start with the basics.
Yeah, what is money, right?
What is money?
Well, at its most basic level, it's just a medium of exchange.
Okay.
It's what we use to trade goods and services without having to barter.
Barter, right? Like just straight up trading my stuff for your stuff.
Exactly. And that can get really complicated.
Yeah.
Like imagine you have a surplus of rice, but you need new clothes.
Okay.
You'd have to find someone who not only wants your rice, but also has clothes in your size and that you like.
Yeah, that sounds like a nightmare.
It's a huge hassle. Economists call it the double coincidence of wants problem.
That's a mouthful.
It is.
Yeah.
But it basically means that bartering is really inefficient.
So money solves that problem.
Exactly. It acts as this common medium that everyone accepts.
I see. So instead of trading rice for clothes,
You sell your rice for money and then use that money to buy clothes.
makes sense. So it's all about simplifying transactions.
Exactly. That's one of the main functions of money. But there's more.
Okay, like what?
Well, money also acts as a unit of account.
A unit of account. What's that?
It's like a common measure of value for everything in the economy.
Okay.
So for example, let's say a wristwatch costs 500
Right.
and a pen costs 10 euros.
Okay.
By comparing those prices, you instantly know that the watch is worth 50 times more than the pen.
Gotcha. So it's a way to compare the value of different things.
Exactly, and this is super important for making economic decisions.
Yeah, I can see that.
Now, here's where things get a little tricky.
Oh, boy.
This unit of account function is also affected by inflation.
Inflation.
Yeah, when prices in general go up.
Oh, yeah, I've heard about that.
So as prices rise, the purchasing power of your money actually goes down.
Meaning you can buy less with the same amount of money?
Exactly. That's why inflation can be a real problem.
Interesting. So money is more complex than I initially thought?
It is. And we haven't even talked about its role as a store of value yet.
Store of value, right? You mentioned that earlier.
Yeah, so besides facilitating transactions and measuring value,
Right.
money also allows us to hold on to our wealth for the future.
I mean, that makes sense. I don't spend all my money at once.
Right, and you probably don't want to store your wealth in something like rice, which can rot.
Definitely not.
So money provides a more durable and convenient way to store your wealth.
Okay, but couldn't you store wealth in other assets too, like gold or stocks?
You absolutely can, but money has some advantages.
Like what?
For one, it's more liquid, meaning you can easily convert it back into goods and services when you need to.
That makes sense. You can't really walk into a store and pay with a chunk of gold.
Exactly, and money is universally accepted.
Right. Everyone takes cash or digital payments.
Whereas other assets might not be as readily accepted everywhere.
Interesting. So money really is a versatile tool.
It is, but, having money isn't always enough.
What do you mean?
Well, the amount of money people want to hold can change, and this affects the economy.
Okay, so there's a demand for money, just like there's demand for goods and services.
Exactly, and this demand is influenced by a couple of key factors.
What are they?
First, there's the transaction motive.
Transaction motive.
It basically means people need money to carry out their daily transactions.
Like buying groceries and paying bills.
Exactly, and as you might expect, this demand for money increases as people's incomes rise.
So if I make more money, I'm likely to spend more and need more cash on hand.
Precisely.
Makes sense.
Then there's the speculative motive.
Speculative. Sounds a bit risky.
Well, it has to do with how people view alternative investments, specifically bonds.
Okay, I'm listening.
So bonds are like IOUs issued by governments or companies, and they pay interest over time.
I've heard of those.
Now, the thing about bonds is that their prices and interest rates move in opposite directions.
Really?
Yeah, so if you expect interest rates to go up in the future,
Okay.
you might be hesitant to buy bonds right now.
Because you could miss out on those higher interest rates later.
Exactly. And you might even lose money if you buy a bond today and its price drops tomorrow.
I see. So in that situation, holding on to cash might seem more attractive.
Precisely. And this preference for cash over bonds is what we call the speculative motive for holding money.
Interesting. So people's expectations about interest rates can influence how much money they want to hold.
Exactly. And this can have a big impact on the economy as a whole.
So we've talked about the demand for money, but where does all this money come from?
The supply side.
Right. So what are the sources of money?
Well, there are two main sources.
Okay.
The first is the central bank.
In India, that would be the Reserve Bank of India or the RBI.
Exactly. The RBI has the authority to issue currency.
Right, like the banknotes we use.
Exactly. And they also control the overall money supply through various tools.
Okay, we'll get to those tools in a bit, but what's the other source of money?
Commercial banks.
The banks we all know and love.
Well, sometimes love, sometimes not.
That's true.
But regardless, commercial banks play a crucial role in creating money.
Creating money. I thought only the RBI could do that.
That's a common misconception. But banks create money through the process of lending.
I don't quite follow.
Think about it this way. Imagine back in the old days when goldsmiths were the main financial institutions.
Okay.
People would deposit their gold with the goldsmith for safekeeping,
Right.
and the goldsmith would issue receipts for the gold.
Gotcha.
Now, these receipts started circulating as a form of money themselves.
Really? Just pieces of paper representing gold.
Exactly. They became a medium of exchange because everyone trusted the goldsmith to honor those receipts.
I see.
Now, the clever goldsmiths realized that they didn't need to keep all the gold in their vaults.
Oh boy, here we go.
They could lend out a portion of it, keeping just enough to cover the likely withdrawals.
So they were essentially creating more money by issuing more receipts than they had gold to back them up.
Precisely. And that's essentially what modern banks do with deposits today.
They lend out a portion of the deposits they receive.
Exactly. And when they make those loans, they're effectively creating new money in the system.
Wow, that's pretty mind-blowing.
It is, but there are limits to how much money they can create.
Right, because they can't just lend out all their deposits.
Exactly. The RBI sets a required reserve ratio, or CRR.
CRR, what's that?
It's the percentage of deposits that banks are required to hold in reserve.
So they can't lend out that portion?
Precisely. So let's say someone deposits €100 in a bank.
Okay.
and the CRR is 20%. That means the bank has to keep 20 in reserve and can only lend out the remaining euro.
Gotcha. So the CRR limits how much new money the bank can create.
Exactly. But here's where things get even more interesting.
Lay it on me.
This initial loan of 80 doesn't just disappear.
Right. The borrower will spend it.
Exactly. And whoever receives that euro might deposit it in another bank.
Okay.
And that bank can then lend out 80% of that deposit, which is 64.
So the money keeps getting lent out and deposited again and again?
Precisely. And this creates what's called the money multiplier effect.
Money multiplier. That sounds powerful.
It is. It basically means that a small initial deposit can lead to a much larger increase in the money supply.
How is it calculated?
It's simply 1 divided by the CRR.
So in our example, with the CRR of 20%,
The money multiplier would be 1 divided by 0.2, which is 5.
meaning that initial euro deposit could potentially expand the money supply by 500.
Exactly. That's the power of the money multiplier.
Wow, so the CRR is a pretty important tool for the RBI.
It is. It's one of the ways they can influence the money supply and ultimately the economy.
Okay, so we've talked about the CRR. What other tools does the RBI have?
Well, another important one is the bank rate.
The bank rate.
Yeah, it's the interest rate at which the RBI lends money to commercial banks.
Okay.
So if the RBI wants to decrease the money supply, they can increase the bank rate.
Making it more expensive for banks to borrow money.
Exactly. And that discourages banks from lending, which in turn reduces the money supply.
Makes sense, and if they want to increase the money supply.
They can lower the bank rate, making it cheaper for banks to borrow and encouraging lending.
Interesting. So the bank rate is like a lever that the RBI can use to control the flow of money.
Precisely. And then there are open market operations.
Open market what now?
It sounds complicated, but it's basically just the RBI buying or selling government bonds in the open market.
Okay, and how does that affect the money supply?
Well, when the RBI buys bonds, they're injecting money into the economy.
Because they're paying for those bonds with newly created money?
Exactly. And when they sell bonds, they're pulling money out of the economy.
I see. So it's like adding or removing water from a pool to adjust the water level.
That's a good analogy.
So the RBI has these different tools to control the money supply.
They do, and they use them to try and keep the economy stable and growing.
That sounds like a tough job.
It can be, especially in today's complex financial world.
Speaking of complexity, I've been hearing a lot about this idea of a cashless society.
Yeah, it's a trend we're seeing in many countries, including India.
Right, with things like Yon-Don accounts and e-wallets becoming more popular.
Exactly, and it's fundamentally changing how we think about money.
How so?
Well, in a cashless society, money is no longer primarily physical banknotes and coins.
Instead, it's just digital information stored in computers.
Precisely. So it raises questions about how we define money and how central banks manage it.
It's definitely something to keep an eye on.
It is, and it's just one example of how the world of money and banking is constantly evolving.
So to wrap things up, it seems like money is way more than just the cash in our wallets.
Absolutely. It's a complex system that underpins the entire economy.
And it plays a vital role in facilitating exchange, measuring value, and storing wealth.
Exactly, and the interaction between the central bank and commercial banks is crucial for managing this system.
This has been a fascinating deep dive.
It has.
It makes you wonder how the increasing dominance of digital transactions might reshape the future of money,
For sure.
and what implications that could have for central banks and for us as individuals.
Definitely something to ponder.
Definitely food for thought. Thanks for joining me for this insightful
It
exploration.
was my pleasure.
And to all our listeners out there, keep those questions coming, and we'll see you next time on The Deep Dive.
See ya.
Bye.
Chapter 4. Determination of Income and Employment.
All right, so today we're diving into something pretty fundamental. You know, what actually determines how much a whole country earns and how many jobs are out there? It's a big question, right?
It is, and the models we'll be looking at, well, they're simplified, but they get to the heart of how income and employment are linked. We make some assumptions along the way, like, let's say prices are stable for now.
Right, got to start somewhere. So it's all about understanding this thing called aggregate demand, I guess. That's like the total spending everyone's planning to do.
Exactly. And in our basic model, it's got two main players. Households, like us buying stuff, that's consumption, and firms doing investments.
Okay, I'm following. So when we say planned spending, is that like different from what actually happens?
You're sharp. Economists make that distinction. Ex ante is the plan. Ex post is the reality. Like, say a company plans to add $100,000 worth of robots to its factory. That's ex-ante investment. But maybe demand wasn't what they expected, and they only end up with $70,000 worth extra.
Ah, I see. Ex post, they invested less than they thought. Makes sense. Okay, so a big chunk of this planned spending is us, the consumers. And the chapter you sent talks about this thing, the consumption function. It's got an equation and all.
Right. C equals C bar plus little c times Y. Sounds scary, but the idea is pretty simple.
Break it down for me.
So your total spending, that's C, has two parts. C bar is like your baseline spending, the stuff you absolutely got to buy, even if you had zero income. Food, shelter, the essentials.
Makes sense. But obviously, most of us spend more than just the bare minimum.
Exactly. That's where the second part comes in. Little c times Y. This is the spending that changes depending on how much you earn. That's Y, your income. And little c. That tells us how much of each extra dollar you get you actually spend. We call it the marginal propensity to consume, or MPC.
MPC, got it. So if my MPC is, say, 0.8.
Then for every extra dollar you earn, you're spending 80 cents.
All right, I'm with you. And the rest, the 20 cents, I'm saving. Which brings us to the savings function, right? S equals Y minus C. And there's another marginal propensity here.
You got it. The marginal propensity to save, or MPS, it's just the flip side of the MPC. If you spend 80 cents of that extra dollar, you're saving 20. So MPC plus MPS always adds up to 1.
Okay, that's pretty neat. Now, the chapter also throws around these terms, average propensity to consume and save. What are those about?
Think of those as big picture views. Average propensity to consume, APC, is just the total percentage of your income you spend. APS is the percentage you save. Simple as that.
All right, so we've covered consumption. What about the other piece of the puzzle, investment?
For now, we're assuming it's autonomous, meaning businesses plan a fixed amount of investment, IBAR, regardless of what's happening with income at the moment.
Okay, so it's like they've got a set budget for new factories or whatever, and that's that.
Exactly. Now, if we add everything up, all the planned spending, we get our aggregate demand, AD, to planned consumption, C bar plus C times Y, plus the planned investment, I bar. You can write it as AD equals A bar plus little c times Y, where A bar is just all the autonomous spending lumped together.
All right, that's a mouthful. But the key is that we want this aggregate demand to match up with how much the economy is actually producing, right? That's what equilibrium is all about.
Exactly. When planned spending, or AD, equals the total output, Y, then everything's in balance. No surprises.
And what happens if they don't match?
Well, if planned spending is less than output, businesses end up with a bunch of stuff they didn't sell. Unintended inventory piling up, not a good sign.
Right, that makes sense. So is there a way to figure out what this magical equilibrium income level is?
We can actually solve for it with a bit of algebra. It turns out that equilibrium income, Y equals A bar, divided by 1 minus little c.
Okay, cool. Now, what happens if something changes that initial autonomous spending? Say, businesses get all optimistic and decide to invest more.
That's where things get really interesting. We get this thing called the multiplier effect. Imagine an initial boost in investment, let's say 10 million bucks. That money becomes income for someone, maybe construction workers building a new factory.
Okay, they've got 10 million more to spend now.
Right. And if the MPC is 0.8, they spend 8 million of it. That 8 million becomes income for someone else who then spends a chunk of that and so on.
So it's like a ripple effect through the economy.
Exactly. The initial investment triggers rounds and rounds of spending, each round smaller than the last, but it all adds up. So the final increase in income is way bigger than that initial 10 million.
Wow, that's powerful. So how much bigger are we talking? Like, is there a way to calculate this multiplier thing?
Absolutely. The investment multiplier is simply 1 divided by 1 minus the MPC, or you can also say it's 1 divided by the MPS. So if the MPC is 0.8, the multiplier is 5, meaning a 10 million increase in investment could boost overall income by 50 million.
That's huge. Now, the chapter also brought up this thing called the paradox of thrift. What's that all about? It sounds kind of ominous.
Yeah, it's a bit of a mind bender.
Yeah.
The idea is that if everyone suddenly decides to save more, increase their MPS, the total amount of savings in the economy might not actually go up. It could even fall.
Hold on, how does that make sense? If everyone's saving more, shouldn't the total savings be higher?
It seems intuitive, but here's the thing. If everyone's saving more, they're spending less. That means lower demand for goods and services. Businesses see this, they produce less, and ultimately, incomes fall.
So even though people want to save more, they end up earning less, so they can't actually save more.
Exactly. It's a paradox because what seems like a good thing individually, saving more, can backfire at the level of the whole economy.
And it's like everyone tries to grab a bigger slice of the pie, but the pie itself shrinks.
That's a great way to put it. Now, one last thing the chapter touches on is the idea of full employment income.
Okay, so that's the income level where everyone who wants a job has one, right?
Precisely. And the thing is, the equilibrium level of income we've been talking about, it might not be the same as the full employment level. Sometimes demand is too weak to get us to full employment. The economists call that deficient demand. And sometimes demand is so strong that it pushes the economy past its limits, leading to inflation. That's excess demand.
Okay, I think I'm starting to see the bigger picture here. So a nation's income level is tied to its total planned spending, and this multiplier effect can amplify even small changes in spending. But we also have to watch out for this paradox of thrift and make sure we reach that full employment sweet spot.
You got it. It's a lot to take in, but it really gets to the core of how the economy works.
Absolutely. And it makes you think about what's going on in the real world right now, like what's driving spending and investment decisions.
Definitely something to ponder.
Thanks for diving deep with me today. Until next time.
Chapter 5. Government Budget and the Economy.
All right, so we're diving deep today into government macroeconomics. Specifically, a whole chapter on it.
Yeah, a bit of a dense one.
So we're going to cut through all that jargon, right?
Yeah.
Get to the heart of what really matters when we talk about government budgets, how they work, how they pack a punch, so to speak, out there in the real world.
Right, yeah.
Now, think of this as like your crash course
Exactly.
on government spending,
Yeah.
revenue,
Mm-hmm.
and those ever so important, always in the headlines,
Oh, yeah.
deficits.
Right.
You ready to kick things off?
Absolutely. Let's go.
All right. So right off the bat, the thing that I find really interesting about the government budget is that it's mandated by the Constitution.
It is. Article 112. Yeah.
It's not just some random spreadsheet, right?
Yeah.
It's a statement. It's a powerful statement of intent about how the government plans to kind of steer the economic ship for the year ahead.
Absolutely. And it's got to be laid out every year, starting April 1st.
Right, that financial year.
Yeah.
And it's kind of a tale of two budgets, right? We've got the revenue budget, which is kind of like the day-to-day
Right.
incoming money, day-to-day expenses.
That's it. Yeah. So
Yeah.
it's really focusing on that current financial year. What are we getting in receipts like taxes, and what are we spending on just, normal government functions?
Right, keeping the lights on.
Exactly. Yeah. Interest payments, grants, that kind of thing.
Okay. And then there's a capital budget, that's more long-term focused.
Right. Big picture stuff. This is where we're talking about investments, things like infrastructure, building those roads, bridges, schools, hospitals. Also managing those liabilities that are going to stretch way into the future.
So, okay, with these two budgets in hand, what's the government actually trying to do? What are those big objectives?
All right. So first up, we have the allocation function. And for a real-world example here, think about, let's say, lighthouses. Super important for maritime safety, right? Everybody benefits. But it wouldn't really make sense for a single company to build one just for themselves.
Right. They couldn't charge everyone who uses it.
Exactly. So this is where the government steps in to provide what we call public goods. Things that markets might not be so good at offering because of the whole free rider problem. Everyone wants to benefit without necessarily paying.
Makes sense, yeah. So it's not just about the government doing everything. It's about them stepping in where the market might fall short.
Right, exactly. It's about providing those essential services, whether it's done directly by the government or through some other means.
All right. And then we've got the whole redistribution thing, right? Trying to, I guess, level the playing field a little bit.
Exactly. Using taxes and things like welfare programs, social safety nets to try to even out that income distribution a little bit, aiming for a more just, a fairer society.
Okay. And then last but not least, the stabilization function.
Oh, yeah. This is the government getting proactive, trying to smooth out those economic bumps, the booms and busts.
Right, like intervening to try and keep things steady.
Exactly. By adjusting spending and tax rates, the government can actually influence the overall demand in the economy, pump the brakes a little if things are getting too heated, or give it a bit of gas if we're heading towards a slowdown.
So let's get down to brass tacks. Where does the government get all this money to do all this stuff?
Okay, so the main source is what's called revenue receipts. These are the ones that don't create a debt burden on the government. The big kahuna here is tax revenue. You've got income tax, corporation tax, and of course the big one in India, the goods and services tax, or GST.
Right, which really shook things up when it came in.
Oh, absolutely. Huge reform. And then alongside those, you have non-tax revenue, things like interest receipts, dividends from government investments, profits from public sector undertakings, fees for various government services, and grants.
Okay, so that's one side of the income coin. What's the other?
That would be capital receipts. Now, these can either be debt creating, like taking out loans, or non-debt creating, like when the government sells off some of its assets, like divesting from a public sector undertaking.
So it's about whether they're taking on more debt or using existing assets.
Exactly.
Okay, now let's switch gears and talk about where the money goes, what the government actually spends it on.
Right. So we've got revenue expenditure. This is covering all the regular running costs of the government, things like salaries, pensions, subsidies, interest payments on loans, and grants. Importantly, this type of spending doesn't create any new assets for the government.
Right, it's the essential stuff to keep things running.
Exactly. And a big chunk of this often goes towards what's called non-plan expenditure, which includes, as I said, things like defense, interest payments, subsidies, and administrative expenses. We've seen subsidies especially go up and down quite a bit over the years. It's a politically sensitive issue.
For sure. And then we have capital expenditure.
Right. This is about the long game, spending that leads to asset creation, things like building infrastructure, investing in education and healthcare, acquiring land, machinery, all of that, or even reducing liabilities, paying off debt.
So both sides of the balance sheet.
Exactly. And it's important to remember that both these types of expenditures, revenue and capital, they're not just random. They tie back to the government's overall policy objectives. Historically, we saw this reflected in the five-year plans.
Right, big overarching plans.
Exactly. And these days, there's also the Fiscal Responsibility and Budget Management Act, the FRBMA. That came in back in 2003, and it really set some clear targets for keeping deficits under control, trying to move towards a healthier fiscal situation.
Okay, well, let's talk about those deficits then, because we hear that word thrown around all the time.
We do. It's a big one.
What are they all about?
All right. So when we talk about deficits, we're talking about situations where the government is spending more than it's taking in. And there are a few key types of deficits. You've got the revenue deficit, which is basically saying, hey, the government's day-to-day expenses are higher than its day-to-day income. Not a great sign, as it indicates they're having to dip into other funds just to cover the basics.
Right, like using savings to pay for groceries?
Exactly. Then there's the big one, the fiscal deficit. This looks at the total picture. How much is the government spending overall, and how much is it taking in from all sources, excluding borrowing? The difference, that gap, is the fiscal deficit, and it basically tells you how much money the government needs to borrow to make ends meet.
Okay, so bigger picture stuff. And then we've got you said the primary deficit.
Right. The primary deficit is a bit more focused. It takes the fiscal deficit and strips out the interest payments on past borrowings. It's kind of like saying, let's just look at the current situation, the new spending, and see how things are looking. It gives you a better sense of the government's current fiscal health without getting bogged down by all the baggage of past borrowing.
Okay, makes sense. So how does the government use all this budgeting and spending to actually influence the economy? What tools do they have?
All right, well, that's where fiscal policy comes in. By adjusting spending levels and tax rates, the government can either try to stimulate the economy or cool it down. It's kind of like having your hand on the thermostat, right? You're trying to find that sweet spot.
Right, adjust the temperature.
Exactly. Now, one of the key concepts here is the multiplier effect. And this is the idea that an initial injection of government spending, say, on infrastructure, can actually have a much larger ripple effect throughout the economy, create more jobs, boost demand, lead to even more spending. It multiplies.
Right, a chain reaction.
Exactly. And taxes work in a similar way, although their impact might be a bit less direct. Interestingly, even a simple proportional tax system where everyone pays the same percentage can act as an automatic stabilizer. It helps to smooth out the ups and downs because during an economic downturn, people automatically pay less in taxes, which helps to support their spending and cushion the blow.
Okay, interesting. So it's like built-in shock absorbers.
Exactly. Now, of course, when the government spends more than it takes in, that leads to debt, right?
Right, government debt, which is, it feels like, constantly in the news. Always a hot topic.
It is, and there are a lot of different perspectives on it. One of the big concerns is the burden it might place on future generations. Will they end up facing higher taxes or reduced government services to pay for the borrowing we're doing today? It's a question of intergenerational fairness. Then there's the idea of Ricardian equivalence, which is a bit more theoretical. It suggests that if people are smart and forward-thinking, they might actually increase their savings when they see the government running up debt.
Because they anticipate those future tax hikes.
Exactly. They're like, well, if the government's going to have to pay this back eventually, it's probably going to come out of my pocket down the line, so I better save up now.
Yeah.
But of course, in the real world, things are a bit messier. Not everyone thinks that far ahead.
Right.
And then there's the issue of who holds the debt. Debt that's owed to other countries is generally seen as more of a burden than debt that's held domestically. It's like owing money to your family versus owing money to a bank. Different implications. And of course, too much borrowing by the government can lead to inflation. If there's too much money chasing too few goods and services, prices start to rise. And it can also crowd out private investment. Basically, the government gobbling up all the available funds, leaving less for businesses to invest and grow. Of course, some argue that if government borrowing leads to higher economic output, it could actually stimulate more savings. It's complicated. There are a lot of moving parts.
It sounds like it. So reducing debt, well, that often means making tough choices.
Oh, absolutely. It's about increasing taxes or cutting spending, and that always involves trade-offs. Which programs get priority? Where can we be more efficient? What are the essential services that need to be protected? These are political decisions as much as they are economic ones.
So at the end of the day, the government budget, it's not just numbers on a page, right? It's a reflection of all sorts of values, priorities, choices, and ultimately, those choices have real-world consequences.
Couldn't have said it better myself. That's exactly it. The government budget, it's a story. A story about how a nation chooses to allocate its resources, who benefits, and who might end up bearing the cost.
And those are the choices that shape our lives.
Absolutely. So thinking about everything we've talked about today, what single piece of information do you think offers the clearest, most insightful snapshot into a country's long-term fiscal health? What number would you look at to say, yeah, they're on the right track? Or, oh, trouble ahead. What do you think?
That's a great question. Definitely something for everyone to ponder. Thanks for joining us on this deep dive into government budgets. It's a complex topic, but hopefully we've shed some light on the key concepts and the debates surrounding it.
My pleasure. Always happy to delve into these important economic issues.
Until next time, keep learning and keep questioning.
Chapter 6. Open Economy Macroeconomics.
Hey everyone, and welcome back to the Deep Dive, where we like to take these really complex global issues and try to break them down into something that, hopefully makes sense, right?
Absolutely. I mean, the world economy, talk about complex, but we can definitely shed some light on it, help you all understand how it ticks.
Exactly. So today, we're kind of zooming in on this idea of an open economy, and specifically how it works for a country like India. We've got a ton of research here from various think tanks and reports.
Yeah, a really interesting mix of perspectives on how India interacts with the rest of the world. So we'll be diving into things like how much stuff India buys and sells internationally and how money is flowing in and out of the country. It gets pretty fascinating.
Yeah, because it's not just about India makes this and the world buys it, right?
Yeah.
I mean, there are all these financial flows happening behind the scenes.
Yeah.
Investments, loans.
Right, exactly. And all these things, all these transactions, they create both huge opportunities for a country like India,
Oh, yeah, for sure.
but also some potential complexities that, we definitely need to understand.
For sure. So think of this deep dive as your crash course on how it all works.
Yeah, and we'll be focusing on two key concepts that kind of unlock the whole thing: the balance of payments
Okay.
and foreign exchange rates. And trust me, once you get these, you'll be able to decode a lot of what's happening in the global economy.
All right, let's start with this balance of payments thing.
Yeah.
What is it exactly? If I'm looking at it on a piece of paper, what am I actually seeing?
So the balance of payments, or BOP, everyone loves acronyms, it's basically a record of all the economic transactions between, in this case, India and every other country in the world.
Every transaction, so everything they buy and sell.
Yeah, pretty much. And it's broken down into two main parts. You've got the current account and the capital account.
All right, let's take those one at a time. Current account first. What all falls under that umbrella?
So the current account tracks the day-to-day stuff, like when India exports, say, textiles or agricultural products.
Right, so the actual physical goods going out.
Exactly. And then on the flip side, you've got imports, right? Like the oil that India needs or high-tech machinery.
Gotcha. So it's like keeping score of what's coming in and what's going out.
Yeah, exactly. But it's not just physical goods. It also includes services.
Hmm.
Like India's IT industry is booming, right? So they're exporting software services all over the world, and that generates income that flows back into India.
Makes sense. Anything else?
Yeah, there's one more piece of the current account, transfers. Like, think about the money that Indians working abroad send back to their families. Those remittances, those are huge for India, and that all gets captured in the current account.
Okay, so exports, imports, services, transfers, that's a lot to keep track of. But what does it actually tell us about India's economy?
Well, if a country is importing way more than it's exporting, that means more money is flowing out than in, and that creates what's called a current account deficit, which, isn't always a bad thing, but it's definitely something economists watch closely.
All right, so that's the current account. Now, what about this capital account? What's going on over there?
So the capital account, it's all about international investments and loans. So let's say a foreign company decides to build a factory in India.
Okay.
That's what we call foreign direct investment, or FDI. And it's a big deal because it brings money into the country. That shows up as a credit in the capital account.
Right, so more money coming into India.
Exactly. But then you've also got situations where Indian investors might be buying stocks or bonds in other countries.
Okay.
And that money flowing out, that would show up as a debit in the capital account.
I see. So it's kind of like a two-way street with money coming in and going out through investments.
Exactly. And ideally, what you want is for a current account deficit to be balanced out by a capital account surplus.
Okay. So if India is spending more on imports than it's earning from exports, it can kind of make up for that by attracting more foreign investment.
Exactly. And that would lead to what we call a balanced balance of payments, which basically means that things are, well, balanced. Money coming in equals money going out.
Right. Okay, that makes sense. So looking specifically at India, I mean, we've got all this data in front of us. What's the story the balance of payments is telling us?
Well, if we look at the sample data here, it shows that India has a trade deficit. They're importing more goods, about 240 million US dollars worth, than they're exporting, which is sitting at around 150 million.
Okay, so right away we're seeing that they're spending more on goods from other countries than they're earning from selling their own goods abroad.
Right, which is contributing to a current account deficit of about $38 million.
Yeah, but you said that can be balanced out by the capital account, right?
Exactly. And that's what we see here. India has a capital account surplus of a little over $41 million. So even though they have that trade deficit, they're attracting enough foreign investment to basically offset it.
Interesting. So they're making up for that gap through investments.
Yeah, and that's been a pretty consistent pattern for India, but it does raise some questions about, the long-term impact of relying so heavily on imports.
Right. Okay. Lots to think about there. Now let's move on to this other big concept. Foreign exchange rates. What are those all about?
So the foreign exchange market, it's basically where currencies get traded. It's where, Indian rupees get exchanged for US dollars, euros, yen.
So it's like a giant global currency market.
Yeah, exactly. And the exchange rate, that's just the price of one currency in terms of another. So, for example, today it might take, say, 80 rupees to buy one US dollar.
Okay, so that's the exchange rate. 80 rupees per dollar. But what makes that number go up and down?
Well, just like with anything else, it's all about supply and demand. So let's say India is importing a ton of electronics from China.
Okay.
That means Indian companies need to buy Chinese yuan to pay for those goods.
Right, so they're selling rupees and buying yuan.
Exactly. And that increased demand for yuan can actually push down the value of the rupee. We call that depreciation.
So the rupee is worth less compared to the yuan.
Exactly. On the other hand, if things like India's software exports are doing really well, you have tons of foreign companies needing rupees to pay Indian companies.
Right, because they're buying Indian services.
Exactly. And that increased demand for rupees can push up its value compared to other currencies. That's appreciation.
Gotcha. So it's all about what people need in the market, which is constantly shifting.
Absolutely. And there are other factors too, like speculation and differences in interest rates between countries. It can get pretty complex, but the bottom line is that these exchange rates are constantly moving.
Okay, so just to clarify, if the rupee depreciates, It means that things imported from other countries become more expensive for people in India, right?
Exactly. Because you need more rupees to buy the same amount of foreign currency.
Okay, that makes sense. And on the flip side, if the rupee appreciates, imports become cheaper.
Right. But it can also make Indian exports more expensive for buyers in other countries, which can hurt certain industries.
Right, there are always trade-offs.
Yeah.
Now, you mentioned that exchange rates are constantly moving, but are they always determined by the market? Or can governments step in and kind of control things?
Yeah, that's a good question. So you've got different systems. Sometimes you have what's called a flexible exchange rate, where the value is literally determined by supply and demand in the market.
Okay.
But then you've also got fixed exchange rates, where the government pegs its currency to another currency, like the US dollar, or to a basket of currencies, and they set a specific rate.
And how do they actually keep it fixed?
Well, the central bank has to step in and buy or sell foreign currency to maintain that fixed rate. If the rupee is under pressure to depreciate, they'll sell dollars and buy rupees to prop it up.
So they're actively intervening in the market.
Exactly. And that can be effective for a while, but it can also be really tricky to maintain, especially if there's a lot of pressure on the currency to move in a different direction.
Okay, so you've got flexible rates, fixed rates, anything in between.
Yeah, there's also what we call managed floating. It's kind of a hybrid approach where the central bank will intervene in the market to smooth out any really big swings in the exchange rate.
So they're not fixing it completely, but they're kind of nudging it in the direction they want.
Yeah, exactly. It's like they're trying to keep things relatively stable without being completely hands off.
Okay, so wrapping it all up, we've got the balance of payments, which tracks all the economic transactions between India and the rest of the world, and we've got foreign exchange rates, which determine the value of the rupee compared to other currencies, and both of these things are constantly interacting and impacting India's economy.
Exactly. I mean, it's a really dynamic picture, especially for a country like India that's so integrated into the global economy.
Right, with so much potential, but also facing, its fair share of challenges. So as we leave you today, think about this. How might unexpected shifts in global trade, or maybe a sudden surge in foreign investment, impact India's balance of payments and the value of the rupee in the future? It's a complex web of interconnected forces, and understanding these concepts is key to making sense of it all. Thanks for tuning in.
Thanks for having me.